And joining us today is Erin Kerrigan. That's spelled Kerrigan, which we should have a graphic on your screen shortly. She's founder and managing director of Kerrigan Advisors. Erin, welcome to VADA Live.
So great to be with you, Dan. I've never been interviewed by another Kerrigan, so this is pretty fun.
It's quite amazing, and at time of recording, it's around St. Patrick's Day as well, and you're a Notre Dame fan too, Erin, right? It just seems like we have a theme going already.
Already. I actually happen to be here at Notre Dame doing this interview, so that's kind of fun, as St. Patty's Day is right around the corner.
I've heard great things about South Bend, Indiana, have not visited yet. Well, Erin, a ton to get into. Let's just start overall, if you don't mind. How would you describe the buy-sell market right now compared to where we were a year ago? I know that's a loaded question, go a ton of different directions with that, but what's your takeaway there?
Well, we're just wrapping up our 2025 Blue Sky Report for the full year. So these are topics that are really top of mind for me because I've been knee-deep in that analysis. The buy-sell market remains tremendously strong and continues to grow. And it's surprising to many. I think that we thought perhaps the surge we saw during the pandemic was a one-hit wonder, but in fact, it was not. The consolidation trend accelerated, and we don't see that slowing down anytime soon. We had over 450 transactions in 25. 26 seems equally as robust from our vantage point at Kerrigan Advisors. So we expect that acceleration continues. And just to give the audience a sense of that, it's more than double pre-pandemic levels. So you really have seen a continuation of high levels of consolidation, and I think this is where the industry is and will continue to be.
Thank you for giving that preview, that overall view of things, diving a bit into news headlines. And Don Hall recently shared at VADA a really, really interesting leadership message regarding China. And he had said it's a complex, long-term challenge that requires serious engagement from dealers, associations, and policymakers, those audiences. Erin, what's your take there related to the topic?
I could not agree with Don more. I think that there can be a false sense of security here in this amazing country. My youngest is actually an Army ROTC candidate at Notre Dame, so I love this country, and yet I think we have this moat around us because we don't have any Chinese vehicles that gives us a false sense of security, which we shouldn't have. I mean, the Chinese are taking major global market share. If you look at unit sales, change in unit sales globally, which we need to look at because while we have no doubt the best retail market, auto retail market in the world, our car companies, our OEMs that we represent are global companies. They're operating in a global marketplace. So when they lose global market share, that has an impact on us as those that work in the auto retail industry in the U.S. So to give you a sense, since 2019, BYD has added 2.5 plus billion units in sales. So they've increased their sales by 2.5 billion. By contrast, you have companies like VW who have lost more than 2.5 billion in sales.
Right.
So that's a challenge when you're losing sales. General Motors, 1.7 billion down. Again, the Chinese are up significantly. And one of the things to think about is the last time we were at a 17 million SAR, we didn't have those competitors. It was just the legacy OEMs. So I think sometimes folks say things like, well, this franchise is cyclical. A CJDR, Nissan, they're cyclical. They go up and they go down. The difference is the next time the SAR rises, there's just going to be more competitors in that mix. We didn't have Tesla the last time we were, not meaningfully, the last time we were at a 17 million SAR or, a high 16 million SAR. So I do think that this time is different. We have a major global competitor. China represents 50% of the auto manufacturing in the globe. So, and they're not stopping. They view this industry, the automotive industry, as when they have to dominate and win to show that they are an economic powerhouse in the world. And so I do think that we as an industry need to be very cognizant of this. I thought it was quite interesting in the last earnings call by the publics, the U.S. public dealer groups, many of whom have entered into international markets. They started talking about their Chinese franchises that they are now representing outside the U.S. So the idea that we can buffer ourselves from this major global competitor forever is I think, really misguided. And I think that every U.S. dealer should be keeping a close eye and keeping themselves well informed of what's going on globally and the impacts of Chinese OEMs' rise on their legacy OEMs that they're representing.
And speaking of geography, we came across a great CPT interview where you noted that's becoming a bigger factor again in dealership performance valuations. What are you seeing in terms of regional trends across the U.S., possibly here in Virginia too?
Yeah, certainly. So the largest market for buy-sells is the southern U.S., which we're including Virginia in that. I know that can be debatable at times, but by some. But Northern Virginia, including Northern Virginia. So that is the largest buy-sell market. Almost 50% of the transactions in the country occurred in the southern U.S. Now, that is not by coincidence. That is the area of the country that has the greatest population growth. It has the most amenable regulations for car dealers. It's the generally easiest place to do business. So it's not surprising that capital is flowing to that area of the country. In terms of Virginia specifically, Virginia had over 50 dealerships trade hands in 23. Now that's because of our client, the Coons Automotive Group, that represented 21 of those dealerships that closed that year when it sold to Asbury. Last year was a slower buy-sell year. I think there were about 4 buy-sells in the state. So we did see a little bit of a slowdown. But I think what's important to think about is there is a bit of a misunderstanding in where we are in our consolidation process. And I say that in that if you look at the industry, the average dealer owns 2 to 3 dealerships. So that seems really fragmented. If you look at the industry on a revenue basis, it's much less fragmented. By way of example, we've done the analysis and about 30% of the dealerships, so the rooftops, represent about 70% of the unit sales in the industry. Wow. So from a revenue standpoint, we're very consolidated. And we're probably, and that's where we're seeing more of the consolidation. So when we look at, this how many rooftops traded hands, it can be a little bit, it can look a little like, oh my gosh, there's just so much, consolidation in these, but a lot of it's smaller markets. What we're seeing is the largest groups are looking for the Coons Automotive groups. So they're looking for monumental scale, both on a rooftop level. So they're seeking the highest volume dealerships and they're seeking the highest volume platforms where you own significant market share in the market, as Coons did in Northern Virginia. And I think that's where we're seeing much more consolidation in metros like where you are in Richmond. So, and in fact, if we look at the top 10 fastest growing markets in the country, we analyze those markets and over 50%, the majority of the top franchises are already in the hands of the top 150, meaning it's not actually quite as fragmented as the industry might seem or feel.
Takeaways for dealers. The data are really, really interesting. How do you think they should interpret that as it relates to maybe operations, strategic decisions? What do you think that message sent to them?
I think the key is that the collection of rooftops for the sake of collection is probably not a great strategy. we actually talk about the consolidation in our industry is really moving from a game of checkers to chess. So regional market share, local market share really matters. And as you chart your course as an organization, the idea of inertia and just owning 2 stores is probably not a great long-term strategy if you're looking to increase the value of your business. If you're just looking to, if you're satisfied with the current cash flow and know that maybe your enterprise value might not be as high in the future as it is today, that's probably fine. If you just like the cash flow and like the business and it satisfies you every day, then it's awesome because it's a wonderful business. However, if you're looking to really grow the value of your business, growth is an imperative, scale is an imperative, and the way you grow strategically within the market you operate so that you add scale is the way we see dealers adding the most value to their business, because ultimately we're probably in the 4th, 5th inning of industry consolidation on a regional level, and you're going to see eventually more and more consolidation where the buyers are interested in buying groups with scale in a marketplace or the top volume stores in a marketplace. So I think that volume really matters both on a rooftop and a group level.
And you mentioned there's still more buyers than sellers in today's market. Anything driving that imbalance, and any message there to dealers maybe considering sale or some moves?
Can you just repeat that question one more time?
Yeah, of course. It's the fun of virtual end of things. And
I was thinking about the answer and then I shifted. So yeah, let me give it to you.
And we're here all day, and we can keep chatting. Yeah, we can go to a different direction entirely. We had come across just saying in some of the research for this segment, there are more buyers than sellers in today's market. What do you think is driving that imbalance, and what does that signal to dealers, perhaps someone who's considering a sale or making a move?
I mean, yeah, obviously it's best to sell in a seller's market. And we are definitely in a seller's market, particularly if you have dealerships that are high volume, if you have, at least within your group, a few marquee dealerships, one of those select few that are in the highest demand. The Toyotas, the Lexus, the Mercedes, Porsche, BMW, those franchises are in such high demand because, again, they're chess pieces. And if you're growing in a market and you want to own the top franchises, there are only so many chess pieces to get. And so you can really... it's good to sell in a seller's market for those that are considering it. And I think that it's very difficult to time a market. I always tell people, they say, well, I'm just going to do 1 or 2 things, and then I'm thinking I'm going to sell in 5 years. Is that a good idea when people ask me that? And I'm just like, I don't have a crystal ball. I have no idea what the world's going to look like in 5 years. The only thing I can say is right now. And right now, it's a very good market for sellers. In the future, I have no idea. I mean, we have so many things coming down the pike. And as Don Hall astutely points out, the global economy has major implications for us. And I think it is important to think about all those things. Not to say anyone needs to sell right now. I mean, it's a great auto retail market. However, it's important to know that the one thing I know is that the market will not stay the same. So if you are thinking about selling, the one thing I would say is don't presume that in 5 years' time and whatever the age you are, that you say, okay, I'm going to sell when I'm 70. Okay, that's great. But just know that you don't know if the valuation you have today will be the same when you're 70. It may actually not. It could be significantly lower, maybe higher. Although I will say from where we sit, especially for the top franchises, valuations are either at their peak or not far off of the peak that we saw during the height of the COVID earnings. So, we're still seeing tremendous valuations in the marketplace. And I don't know how long that lasts, but certainly while it's going, we're very pleased for our clients.
One thing I wanted to ask about, Erin, was luxury franchises. And you had mentioned a few, just they continue to command strong valuations through and through, which was interesting to me. I'm looking at other industries saying, oh my gosh, that's where airline industry is going with seats. And I said, well, wait, last time I checked, and granted, I'm not going into the data every single day. I thought economy was definitely making some moves there. From the luxury space, what's really fueling that? And what makes that particularly attractive? What's going well there?
It is kind of interesting because luxury sales were more muted in 2025. Obviously, we know about the fact that we do have an affordability issue in the country, but we also have a K-shaped economy, meaning the top 10% of earners represent 50% of consumption in our country, which is an very interesting data point. You also have the top 10% earners represent 80% of the stock market. So that side of the equation is quite well funded, has seen their bank accounts rise considerably. Now, I know in 26 we've had a more volatile stock market with the current Middle East challenges and crisis, but we still see that the capital accounts of the top 10% are flush, and therefore demand for luxury vehicles remains strong. Luxury can be a little bit confusing because when there are franchises in that mix that maybe aren't as high in demand as others, like the top ones, the Mercedes and Porsche and Lexus and BMW. When you look at those top ones, they're doing tremendously well. And so there's so few of them. It's like joining a small club, and they're not going to keep multiplying. There's a finite number of those franchises, and that creates a very attractive business model for the franchisee. And that's why if you don't have one of those, and if you are charting a course to be a major player in this industry, to be in that top 150, you need to take that chess piece off the table, and that's what the major consolidators are doing. And that's why you see a disproportionate amount of the buy-sell market in terms of buy-sells, disproportionate relative to the number of franchises, a disproportionate share of the buy-sell market is in that import luxury segment.
Appreciate you clarifying there, Erin. It's amazing, interesting, and commonsensical in many ways, but so many factors that can fuel into that. One thing I wanted to ask too was regarding PE, private equity. Where's that right now in terms of interest? What are you seeing that real investors playing in dealership acquisitions? I don't know what's the story there of late.
So it's actually a trend we're going to be writing about in our full year Blue Sky report. So I was so excited that you asked that question. It's very interesting. I mean, one of the things we're seeing in our industry as well is with consolidation, with, again, 70% of the sales being represented by 30% of the rooftops, and with the top 150 growing their revenue, interestingly, in the last 10 years, 85%. Now, they've grown their revenue. They've only grown their store count 41%. So again, they are building, the largest groups. Now, what does that mean? And actually, another interesting stat is their average, the top 150's average revenue per group is over $2.7 billion. Now, that includes the publics, but nonetheless, that's the average of 150 groups. So those are mega organizations. And the reason I bring that up is that when you get to that size, you're not just relying on your personal balance sheet anymore. Every other industry, as it matures to that level, starts to tap into what's called other people's money. And it's simply because to be super strategic in the way you grow, it's really hard to do that. And very few companies stay family owned and private when you get to that size of an enterprise. Our industry has been slower to consolidate, but we are now at that important inflection point where many families and many private groups are saying, I do want to continue to grow, but we do need a strategic capital partner and thought partner in how we do this. And so we've seen a 50% increase 50% plus increase in the number of top 150 dealership groups with outside capital. So that's a big increase. And there are more and more capital partners that are structuring themselves in a way that they can be approved by the OEMs. They understand the OEMs' issues with private capital investing in our industry. The OEMs do not want traditional private equity firms to be in this industry because those firms have a finite time horizon in which they can invest. Yeah. That being said, the OEMs are open to family offices. They're open to evergreen capital funds that can invest and stay in the business. And we think that is a trend that will certainly not go away anytime soon. And if anything, we think it's going to be a major driver of consolidation going forward.
Wow, it's really interesting. Blue Sky Report, Erin, what is it? How's it beneficial? I understand it is a benchmark for dealers. Some may be familiar with it.
So it is a labor of love. I do write it from start to finish with the team's support, of course, and lots of the team at Kerrigan Advisors weighing in on every piece of it. But it is really our firm's calling card. We feel strongly that when we do that report, we're better at what we do for our clients because we stay top of the market in terms of what's going on, and frankly do our homework every quarter. And it's like in life, when you do your homework, you're better at what you do. So that's what we do. We write that report 4 times a year. And it now goes to 20,000 people in 35 countries. So it is the most broadly distributed report in the industry of its kind. And it really is an effort that we make each quarter where throughout the quarter we track trends, and then we dive deep into the data to support the trends that we're seeing. And inevitably, the data supports our hypotheses. And so that's what the report's about. And many of the stats that I've been mentioning on this fun interview are in that report and are discussed. And it is something that we love to do for the industry and to ensure we're providing the highest level of client service to our sell-side clients.
Erin, appreciate you taking time. Closing remarks for dealers in Virginia and beyond. Where do you think their mind should be right now? What is top of mind? What are they perhaps maybe not talking about that should be? What's your take there?
Well, I think dealers in Virginia are very fortunate to be in Virginia. I actually used to live in Northern Virginia at one time in my life and love Virginia as a state. I actually honeymooned in Virginia, another fun fact, since it is for lovers, as we all know. I think Virginia is very well positioned as a state. The growth dynamics are highly attractive. Demand for dealerships in Virginia is strong. It's just one of those states that people want to be in. And I think that Virginia dealers are well positioned to continue to grow their group and their businesses simply from population growth. That being said, I think it is important to think about the way the consolidating market is occurring. Now, if you're in a smaller rural area, that's not as much where buyers are looking. So that being said, you're also probably pretty well positioned to just continue to run a nice, stable business. If you're in a major metro, if you're in Richmond, if you're in the Washington, D.C. market, if you're in other areas, other major metros in Virginia, you do have the defense base, which is highly attractive, such an anchor to the state and to those metros. So that's very attractive. You will continue to see those metros consolidate. So I think it is an opportune time to think through your strategy of how you want to grow your business. I think the days of just waiting opportunistically for something to come along is really not a strategy. It is important to start planning out how is your business going to grow and be part of the next generation of leading dealer groups. Or how are you going to plan your exit? I think that inertia is not a great strategy, nor is hope. I think you want to have a plan, and especially with all the changes coming down the pike. And we didn't even talk about AI, but AI is another fundamental shift in our industry. And one interesting point to wrap this up is we've also been analyzing Carvana, who is actively using AI. 30% of their sales have no human interaction. That's a pretty meaningful percent. They are now entering the new car business. They have 6 Stellantis franchises. They, in my estimation, probably will continue to buy more. I don't know anything about that, but it's my guess. And if you look at their revenue per location, they're at $500 million. Now, if they can replicate that high volume model on the new car side, that's employing AI in a meaningful way, that's going to be a pretty big change agent to all of us. And it's something that I think, again, we should all be highly watchful of. I mean, they're now in our business. They're now new car dealers. They're part of us, and that means they're also future potential competitors.
Erin, appreciate you mentioning AI. For dealers interested in learning more, we had done a special series, a number of videos with various experts. Erin, really appreciate you joining us today for VADA Live. You've been hearing from Erin Kerrigan, founder and managing director of Kerrigan Advisors, coincidentally joining us around St. Patrick's Day from South Bend, Indiana. Quick postscript before we go. It is convention season, and we hope you plan on joining us in Virginia Beach at the Marriott Oceanfront Resort in Virginia Beach. It's June 22nd through the 25th. Speakers are being announced, so are special events. Please take time to visit VADA.com and register today. We thank you for watching VADA Live. I'm Dan Carrigan. See you next time.